Hey guys, welcome. Thank you for being here. Hopefully by the end of this presentation, you will see exactly why the majority of the stuff you find online is utter nonsense, and you'll start to build concepts into how you can get a systematic, profitable strategy moving forward. Now, I use the word systematic with caution, and that's because 99% of the strategies which you see out there that say they're systematic are utter useless. And I'll prove this to you, and I'll let you know how we build strategies and how you can build them automatically, thousands at any one time, and filtered right down through to one which would work. So for every one strategy that we have that works, there's probably been about 1,000, 2,000 strategies generated, crunched up, optimized, which gives us a good strategy moving forward. So let's begin by looking at what I'll call random market theory, and then we'll have a look at some of the stuff we see online. So I'll go on YouTube, just type some search into the Forex, and we'll just have a look at the top 3, 4 that pop up. After that, we'll then start looking at why strategies fail and having a longer term view on developing strategies, why it's so important. I'll show you how we develop our strategies, and then we can close from there. So let's jump straight onto the screen, and we'll take a look at a chart. So I'm just popping up this Vantage chart here. We can see it's a chart of euro dollar, and it's an H1 chart, which means any one of these bars, I'll just zoom in a bit. So every one of these bars is equivalent to 1 hour's worth of price movements, and this is a chart of 2019. So if we go to the daily view and zoom out a bit, we can see it's just 1 year's worth of price data. Now this is typically what we'll see when we're looking at any charts. The one problem with this chart is it is fictitious. So it's euro dollar, it's fictitious, it's made up, it's 110% random. Everything other than the open price in December 19 is made up and it's random, and I use an Excel random formula to do so. I'll just launch Excel and show you what that looks like. So each one of these lines represents 1 minute of price action data. So that's 1 minute, 1 minute, 1 minute, 1 minute. To get access to the data, you can go to Duca's copy, or you can go to hist data download. So I'll pop one open so you can see. If you go to hist data.com, and here you can download historical data for the MT4 platform to the nearest tick, which is the smallest increment of price movement, but I'll be looking at a 1 minute data, which gives you the exact same equity curve. So we've downloaded the data. It comes in a CSV file. Within MetaTrader, we go to Tools, History Center, and we delete all the data from the History Center. What we'll then do once we run the random command is we'll import, and you can see this random data here. We import this random data set, and we create 2 charts. I created 2 charts. You can create more. I created one 60-minute chart, which I'll be using to show you examples, and one D1 chart, which I'll also use to show you examples. Whilst we are here, I'll just show you the fake chart. This is 2019 versus a real chart. So I'll delineate what a real chart looks like in just a moment. We'll close the strategy tester, and we'll get the chart window open, and it's for euro dollar. So euro USD chart window, and let's just load a blank template up. Right, so I'll stick on the daily, and we'll go back 12 months. Well, we'll go back for 2019, so that's February. Okay, so that's the, let's go back one more. Yeah, that's fine. So that's the 1st of Jan 2020, and we'll have a look. We'll go back to 2019. Are we looking? So I need to zoom out a bit. Let's make it a bit easier. There we go. So this is an actual live chart. You can tell it's a live chart because we're connected down here. This is what 2019 looks like for Euro versus USD, and this is what our fake chart looks like. So if we look at the real charts, just to put a line going down and make it color we can see. So we can see this moved in what would be sold to you as a downward channel, right? Which is whenever it touches here, so these are all sell opportunities within these will all be called sell opportunities within the retail space. Let's get rid of that. So let's look at that, and let's look at our fake chart, and we can see the fake chart is completely different. We have an area here where price went down a bit and then broke and kept going up. So this is evidence one of a fake chart that we're using. Just to explain the formulas again, so we're clear. Each one of these rows represents 1 minute's worth of price data. I'm using a command, random between, to create a random data set here. This 2.3 is equivalent to, or 23 is equivalent to 2.3, which is 2.3 pips. And that's the average movement of 1 minute of a 1 minute candle, hence why we're using a random between. Now, if I'm to click on it, you can see the numbers changing. You see all the numbers changing, which then creates a brand new chart. So trust me, I've done this several times. What you're about to see would happen over and over again. So I'm clicking it. This is a brand new chart. It will print, and this just so happens to be the one we're using. So now we can see we've built a random chart. Let's have a look at some of the standard technical analysis we're taught. In fact, what I'll do at this point is I'll just go to YouTube and I'll show you. I typed in Forex strategies that work, and here we go. We've got all of these. We'll just have a look at these top 5. So I did a little bit of analysis on them. Just went to view 200,000 views, 700,000 views, 1.4 million views. And this is exactly the reason why people are failing in the markets. To summarize what those videos said, here we are. I thought I'd just put it in a little slide. Video 1, which was Trader Nick. This is looking at a head and shoulders pattern, and he's saying this is where you enter, this is where you stop, and yeah, this came up a couple times when I run searches. So you're looking for head and shoulders, and you're looking for your stop above there, your TP below there. Everyone talks minus 50. This is how you make 100 pips a day. Nonsense. Here's an example from Baby Pips, which is a free site. www.bpips.com. It's got all of these strategies on there. So there's a head, there's a shoulder, you buy, stop above there, and all the rest of it. Another one, I just put the screenshots here of the trading strategy that was put up. So this is a pullback strategy. A market breaks, it comes down, retests, you buy. Here we go, counter trend. Then we have range bound strategies, and then we have a breakout strategies. Again, all nonsense if you don't know what really moves price. This one again was looking at a trend breakout. So it's saying, well, if it breaks and it retests, that's when we buy, or that's when we sell. There was one more which I didn't quite capture, which was this one here, this simple profitable strategy, 1.4 million views. This was using indicators, moving average indicators, to let you know when to buy or sell. And all of this, you will see evidence of why it doesn't work and why it's all nonsense, which is what is being spouted out there. So zooming into this chart, let's go to an H1. You'll notice I'm only looking at H1 and D1 because H4 doesn't exist, because I've not made up that chart, and neither do any of the other time frames. It's just the H1 and the D1 because that's what I made up using random data. So let's have a look at straight away. I'm seeing something along the lines of a head and shoulders pattern here. So we're seeing I'll just draw this out. Okay, so what we've got here on a random chart, which we've created, is pretty much identical to what Mr. Forex Guru over here is saying. We can see the left shoulder, the right shoulder, and the head, and then the market breaks and we take a short trade down. And that's exactly what's happened here on a totally random chart. So how can you say with any degree of confidence that your strategy is going to work if we can prove that on a random chart the same thing exists? And this is the problem with most of the retail education which exists out there, is they might mean well, and we can see this, but it's completely random. You can't teach something like that unless you've got evidence that it works. And the only way you can prove it to me is either show me historical track record of testing that it's worked, or show me a live account. And I can guarantee none of them have any of those. So there's two things which you need to see. We need to see evidence of a track record, and we need to see backtest evidence that the strategy works. So let's just have a look at some more options, which we will normally see. So if you're new to trading, all of these might not make sense to you, but once you join our membership, or you become a member, I'll give you access to free Forex education, which teaches you the basics of all of this quote unquote technical analysis, which we're taught. So here we can see resistance, which is when the market moves up, turns, we're looking for it to move up again and turn. So we can see that here. And if you've got an eagle eye, you can spot another head and shoulders pattern. So that's the shoulder and the head. So left shoulder, head, right shoulder. Again, where's that coming from? Random. Next, we can have a look at a trend line. So this is another strategy. This is something you see a lot of, trend lines and channels. So if the market comes here, you'll be looking at buying, and then buying, And then you have a trend line break, which you will then be taught. This is a trend line break. When the market breaks the trend line, you'll then be taught. So from there, we're going to start looking for selling opportunities. So it's broken the trend line. You're looking for selling opportunities. Again, we can see what looks like a perfect channel. The market bounces off this, bounces off it, bounces off it, bounces off. And it's just a random chart we just made up, right? So the question is, how can people say that their stuff works when we can prove that on a random chart, everything they're teaching still exists on a fabricated chart? So again, let's have a look at some other examples. I'll go to indicators and let's throw some Bollinger Bands on. Bollinger Bands are typically reversion to the mean systems. In fact, I won't use Bollinger Bands. I use moving averages. The first strategy I ever bought about 8 to 10 years ago, I can't remember exactly when, was a moving average crossover. And I will show you the system when I can find it. It should be in trend and moving averages. So the first system I bought was when the 6 crosses above the 21, we will look to buy or sell. So what that means is when when blue crosses above red, we're looking to buy. When blue crosses below red, we're looking to sell. So as things stand right now, blue's crossed above, we'll be looking to buy. And in hindsight, if I zoom in, get rid of that. If I zoom in, this looks good. Let me just alter this a bit to make it a bit smoother. So these are 50. And this was a strategy I was sold on. And it looks brilliant, right? So when the blue crosses above the red, you buy and you hold on. So all this time you'd have made money. And then it crosses below, maybe one loss, and right now we're in profits. Again, fake random chart. Now, every single indicator out there performs the exact way they're supposed to, which is they manipulate price. So price is the only fact. Indicators are a distortion of that, whereby when a moving average crosses below, it's just saying, well, price, this is what price has done. So it's giving you another view of price, but it is not anything magical. And that's what we need to understand. This isn't a magic formula which does X, Y, Z, that when it crosses, it must do this. So you would get those sales pitches where they say, I've got an indicator that, can pick tops and bottoms and can do all the rest of it. It can do sometimes, other times it won't. And when we look at the next phase of this presentation, you would see exactly why strategies win and strategies lose, especially lose in the long term. So just scrolling back on this chart, we can see some more beautiful examples of the moving average crossover and how it's making money in the long term. If I was to run a Forex robot, an expert advisor, which is a Forex robot, on this, you would see it actually ended up losing this year. And that's what got me into algorithms, was because I bought a system that they said was mechanical. You just need to do this when, just need to buy when it crosses and I thought, well, surely we can program that, which is what we did. So this is something which I would ask you to attempt to replicate, and any system you see out there, any indicator you see which is magic, any smart charts, whatever the case is, build a random chart, and I can assure you would see the same strategies which you're being sold on a completely random chart. So that will conclude this section. What I'd like you to do, as I said, is see if you can replicate it. By all means, if you have any questions or queries on it, just send me a DM via Insta. I normally check that once a day, and I'll get back to you, and I'll let you know if you want a copy of the sheet, if you want the formulas. Just let me know. You can pause the video at some point where the formula as well. But if you need me to go through it, let me know, and we'll go through that there. So this is a demonstration of a random chart where we can see every single technical analysis tools or tool set that exists, which we're being taught. So I've just had a look at the top 5 vids on YouTube. One was saying about higher highs, which we can see here. One was saying about break retest, which is here. Let me just put a level here. So the market, we're looking at this zone here. The market was making lower lows, which is a trend we're taught. It broke out, it tested here, and they'll say this is when you buy, because it broke out and it retested. So that's where out of bought. Can we see another example potentially? This isn't, the market had a what we call resistance here. It broke it, came down, retested. That's exactly where I'd have bought, people. I'd have made 3,000 pips. Nonsense. Anyway, so this is the example you can use when it comes to looking at evidence onto why a system does not work, because you would see everything you're taught in a random chart. So I hope this has added some clarity and at least some at least giving you an arsenal, some tools to go to your retail educators with, to see exactly what they're teaching you can be randomized or can be seen in a random chart. So let me go to my other screen. So this is a live screen. As I said, we can see that down here, where with this it's not connected, because if it's connected it will start printing live data. So I had to disconnect it. So looking here, we're going to go into the strategy tester, and what I'll do is I've just been running an optimization on the last 12 months for a system. This is for a moving average crossover system. Now, all of this might look confusing at first, but I'll go into it in detail if you decide to join us as a member. So what we can see here is I've run 400 optimizations on a moving average cross, and we can see the top one made £27, which is not a lot of money, but let's see how that looks. So what I'm going to do is, this is going to be a demonstration of why systems fail, and what you can do to prevent it from failing moving forward. So let me hit the start button and we'll have a look at the graph. Now, in building a moving average crossover strategy, what we essentially do is we say, okay, I'm going to look at a set period of time, or this is what typically happen. You would look at the charts for the last 12 months or so, and you say, okay, I like the strategy, I'm going to use it. You would then start using it, and what can we see here? It moved up, all the way up. Fantastic. 99% model quality. So this is a perfect model, which means for the past 12 months, if you had a moving average that had a fast period of 30 and a slow period of 60, you would have made quite a bit of money, depending on the risk you decided to take. So this is over the last 12 months. Now let's start breaking this down for you. Let me get rid of some of these levels. I always prefer a clean chart when I'm working. And let's get a moving average on. And we'll have a look at exactly what happened. So it was I think one was a 30. Can't remember the other one. Let's take a look. So it was a 30 and a 60. on a H1 time frame. You can see that here, hour 1. So in the last 12 months, if you traded this system, a 30 and a 60, you would have made quite a bit of money. Now, I've just zoomed right out so we can see what it did. So we can see, okay, yeah, that's great. But this is what you call in sample testing. So in sample, I'll just use this one screen for example of all the data. So imagine within this field here is our in sample test. So what that means is we would create a strategy based on the crossovers within this period. And that's the 1 year we've just seen, for example, right? So we just tested it. We can see, oh yeah, it's great. I've just tested it for 12 months. My system works. Let me sell it, or let me trade it. And so you're using in-sample data because this is just data you can see. But what about data you can't see? And this is where we all started off, at least, going wrong. So we build a system using this strategy of a moving average crossover with data we can see. But there is data that you cannot see. Now on a real chart, which we can see here, that's going to be on this side. We can't see this data. We don't know what it's going to do next. Nobody really knows what it's going to do next. So all you can do is use the probabilities of your trading strategy and let the numbers play out and just let it make you money over a long period of time. So looking here, you would build a strategy with in-sample. A real example of in-sample would be all of this. So you build your strategy based on the last 12 months saying, yep, it crossed, and I'll go to my results. Oh yeah, that's brilliant. I like it. But you're missing a huge piece of the puzzle, a massive piece of the puzzle, which is out of sample. So in samples, all great. Anyone can just look back in time and create a strategy based on what they see. So we could say, okay, moving averages work. It's the best thing because look, from here, it crossed and he made all that money. Now, what if this was just this is all the data you had available to you? You'd say, well, this is a golden system, right? It crosses here, you make money, maybe a little loss, you make more money. And look at these big winners. Look at these massive winners. You would absolutely 100% want to go with this strategy. But the out of sample is what really breaks people, because trading forward is difficult. And by using in-sample data, which is flawed, you really don't have much of a chance with out of sample data. So let's take a look at this system, which has performed well over the last year using our in-sample data. Now I'm going to run this back from 2004. So we're going to run the exact same system from 2004 to 2012, and I'll hit start, and let's just wait for it to start printing, and we'll see how well it does. And again, as I said, this is the key. So we build a strategy with in-sample data. The second we start looking forward, because it's been built specifically for a period of time, it never survives the test of time moving forward. And already this has started running. We can see what's happening to the strategy. It is getting obliterated. But we would have tested it for the last 12 months and said, yep, it's a really good strategy. I like it. It's going to make me lots of money. X guru says it works. This guru says it does. I bought into it myself, 6 and 21, as I told you. I bought into it myself, and that is what happened to my equity curve, because I was convinced that with this salesman that this was the winning strategy. I was really convinced. And back in the day when I started, there wasn't as much retail nonsense and all this education out there where people don't know what they're talking about, but they're going to sell you a signal service with no track record to prove it. So none of that really existed back then. And when I saw that, to the naked eye, this makes sense. It makes perfect sense. I thought, well, that's simple enough. When it crosses below, I'm in. But two things now. One, we've seen random market theory, where we can see this on a completely random market. So there's no real benefit, I would say, from a random market to a actual market. It's all the same thing. They're both print price, and they're both the same thing. So I'm going to pause. In fact, I'm just going to stop this test here. There's no need to wait till 2020 from 2004. We can see what it's doing. We can see exactly what it's doing, and it doesn't miraculously change and go up there. If you don't believe me, then run it on your live account and let's see how that goes. But yeah, it just continues down this trajectory. So let's stop this, and let me show you an example of one of our strategies which I developed for the euro dollar chart. So let me just put it here one more time so you remember what this looks like. Freeze frame, pause it if you want, and then let's run it 2004 to now, with, I will use ATM, just use it the top one, and start. So with this, I'll leave this to complete, just so at the end we can see what it's done from 2004 all the way through to now, without it blowing an account at the very last minute. Because again, what you find is, regardless of what percent you make during your trading career, the second you lose 100%, that's your account gone. So you might be 900% up for the year, which will sound brilliant, but as soon as you lose 100%, then you're back to zero. So I'll leave this to run until it gets to the very end, and then I'll pick up from there. So for now, I'll pause and or I'll speed up the video rather, and I'll get back to you when it ends. All right, and it's all completed now. We can see we got to 100%, and we can see the results of this one particular system and the quality of the model, which is 99.9%. So what that means is this is a near perfect model of what happened on the euro dollar over the last 14 years. And this right here is a pretty good equity curve. There was a point here where we had quite a bit of a drawdown. A drawdown is when we are losing money in the markets, but it soon picked up and it's still moving in the right direction. So let's have a look at this report, and this is how you build your edge. So rather than looking at something which has no evidence behind it, here we can actually see evidence. We can see results. We can see something tangible we can use. Now, without looking at how much money you've made and all the rest of it, let's look at your consecutive losses first, because risk is something which is probably the most important thing to me when I'm trading. So consecutive losses, we can see here we have eight losses in a row, and we've seen minus 212 for consecutive loss counts. So already we've got a lot of information on losing, which is, if we're to trade this system and we're to see 10 losses, is that within our tolerance threshold? Possibly, because we've seen 8 before. But if we're to see 20 losses in a row on this system, then it's clearly not performing. Something significant has changed in the market, and this system needs to be re-looked at. Because if in the last 14 years I've only seen 8 losses straight in a row, and all of a sudden I'm seeing 20 losses in a row, then clearly something's wrong. You've lost your edge, and this is where this kind of data really comes in useful and would help all traders, fund managers, signal providers, etc. It would help you guys in the journey. I can see here 2.93% drawdown. Okay, so that means if I'm to put £100, $100 in, I'm going to lose 3 in terms of a drawdown. Yeah, I'm comfortable with that. That's fine. But what if it ends up being 6? Do I have a cutoff? So all of this data, this information here, which we can see, you can also print off a detailed report on it, which gives you every single trade from here as well. So you can see what it looks like. But yeah, we can see every single thing, and you can now build a trading plan which has some kind of data and evidence stuck behind it, where we can say, okay, I know that I'm expecting to lose 8 trades. My threshold would be, let's say, 13 trades, because if it hits 8, so if it gets up to 13 trades down and I'm minus 4%, that means my edge is gone. I stop. I go again with a new edge. And that's where the system which we use to build strategies works, because it looks at all of these elements, which is the out of sample testing. So we looked at the in sample and we looked at the out of sample. We then also have various Monte Carlo tests. These are what if scenarios, and that is key to building a strategy, because here you can see I'm using a broker, IC Markets. If I'm to launch this other broker, you can see I'm using Vantage. All live accounts, I use IG. I've got about 15 different trading accounts trading 15 different strategies for me. Depending on a broker, you could have different slippages. Slippages, if you want to buy something at 100, you probably get it at 105. So you've been slipped 5. So that's a slip. You have different slip, you get different spreads. So the cost of trading is different. So whereby you could have something like here, like this zone here, we might have 1, 2 crosses. On another broker, you might not see that with exactly the same settings because of the difference in spread. In bid and ask, it might cost a little bit more. That's an extreme example, by the way. It'll need to be a bit finer than that. But you could have widened spread, which causes that. You could be on a B-book broker, which means they're market makers and they give you unnecessary spikes. So there are lots of different random factors that come in to building a robust trading strategy.